What is it
Right.
that makes somebody able to make a purchase without selling their existing home?
So it actually leads to a lot of things, which is a great dialogue because I love having conversations with folks about this. So you have to figure out how to put the pieces of the puzzle together. Can their debt ratio work? That's normally your number one stumbling block. Um, the
Okay,
secondary
so
piece,
let's talk about that for a second. So the debt
yeah.
ratio, explain exactly what we're talking about there.
So you take their gross monthly income
Okay.
and then you compare that to the liabilities that show on that credit report. And so what you have to figure out is, can they keep that existing first house mortgage payment in their debt ratios and still qualify for a new house or not? And so if it's yes, then they can move forward and they don't have to make a contingent offer, and they can just go buy a new house and then deal with their existing house as they go through time.
Okay.
Or if they do have a debt ratio problem, then you have to look at, does it need to be contingent? Can they possibly rent their existing house? And
Okay.
that would help cover that payment.
Okay. So this is I know the answer to this, but I'm going to pretend I don't for a second. And I'm just going to pose the question to you like this. So Joe and Betty got a house and they live in California. They want to buy a house here in Arizona, and they're not sure if they want to sell it or rent it out. Let's say they want to rent it, and they come to you and say, Tom, we want to rent it out, and we want to use that income from the rents to qualify for the loan. How does
Right.
that work?
So it's pretty easy in the lending world, which is great. So pretty simple mathematic equation. You get that gross monthly rent that you're going to get from that house, take it times 75% because they do account for some vacancy. You take that 75% number, compare it to the existing house payment. And if those are about even, then all of a sudden that existing house goes fully out of their debt ratio.
Okay. And do they have to demonstrate, how do they demonstrate to you that they're able to get the amount that they tell you they're gonna get?
So that lease payment or that lease agreement needs to be in place prior to closing. So they would
Okay.
need to find a renter prior to the ability to close on the loan. The lease doesn't have to start prior to our closing, but they have to have a lease agreement signed, really, and first month's deposit or security deposit, something in receipt too of funds. So you'll see funds, you'll see a lease agreement, and then we can use the number.
Okay. So if they're in a market where the rents are super hot and they know it's gonna rent quickly, they could conceivably go under contract and you could get them pre-qualified to buy, but you would check that little box on the
Right.
pre-qualification form that says that they are relying on additional income or something to that effect, correct?
Yeah, they're relying on the sale or lease of a property.
Okay, great.
Yeah.
So with that out of the way, what's the next part or the next thing that comes to mind in order to allow somebody to buy before selling an old house?
Well, like you said, John, the one thing when, we currently have a customer right now doing exactly what we're talking about. Part of that other piece of the dialogue is, where do they get the down payment for the new purchase? And so cash and down payment normally becomes the second piece you talk about after debt ratio. And so how do you then structure through that to get them the money to put down on the existing house? And then we can have some dialogue around PMI or not. How do
Right.
you get out of PMI? All that stuff.
So let's just continue with these guys and talk about the options that they were considering, because they were considering all of them. Like
Right.
they really were uncertain about which direction they wanted to take. In fact, I believe they had a final decision about how they were going to come up with that down payment after their offer had been accepted, and they changed from a 5 or 10% down loan to a 20% down loan. So
Correct.
can you talk to me about what options they might have been considering, and how that conversation that you had with them went?
Sure. So we talked through a couple of different things. One is, they're from out of state. We are not licensed in the state that they live, but after trying to divulge down a number of different options on how they could get there, my thought was for them to refinance the house that they live in currently, get
Right.
the cash out via a cash out refinance, take that cash then, and it becomes our down payment down here. When you do that, then you have to recalculate debt ratio to make sure that what they're doing there isn't going to jeopardize their purchase. But for them, that was ideal because they have a ton of equity in their house there. They could pull some out to use it for here. And then ultimately what they want to do with that house, I think they'll decide after they buy the house here.
So they went with 20%, they're going with 20% down on their purchase in Arizona. So that eliminates that mortgage insurance, which
Right.
is a nice reduction on their monthly payment, right?
Right.
Okay.
That's nice. And there's other things, John, where, not to go into too much on it, but they, even if they did 10% down and they had to pay PMI for a couple months, I even walked through with them. Most lenders have what's called a recast, where you can plump down some additional principal and recast the payment and get yourself out of PMI that way too. So it's a broad topic, and there's a lot of different ways to make it work.
How about how does a HELOC come into play? When does a HELOC make more sense than refinancing an existing property?
So you have to be comfortable with the HELOC. We had that exact discussion with them. Not everybody is comfortable with an adjustable rate. Not everybody is comfortable with something that can fluctuate month in, month out, depending on what the Fed does with interest rates. Not knowing how long they were going to keep the house and keep that line of credit gave them a little bit of unease. And so for them, comfort was a locked in fixed rate period of time, and they could just go and get it on their first mortgage. I really do like the HELOC option, especially if it's short term, because rates are pretty good. There's no cost to get it, and to pay it off in 6 or 12 months. I think ultimately that's a better financial answer, but you have to be comfortable with the adjustable rate feature.
Yeah, which I guess if you're talking about, a very short term, if you're going to be selling the place, it makes a lot of sense. And in their case, or in a lot of people's cases, if they're going to keep their property and rent it, I can see why the refi would be the right answer, because it is long term,
Right.
especially if you're going to keep the place for a number of years. The difference between renting and selling is you've got to be comfortable with the idea of being an out-of-town landlord. That has lots of challenges, and it's been my experience that most of the time it's all in our heads. In other words, people worry about those difficulties, and they think in terms of extremes. In other words, they think in terms of somebody renting their house and going in there and absolutely destroying it, like being hard on it. They purposely put concrete down the toilet and all these things we've all heard of people doing. That happens far less than 1% of 1% of the time.
Right.
So the hardest part about being an out-of-town landlord is finding the renter. And really, that's not that hard to do if you have a good agent who understands what things are worth in the rental market.
Right.
You can get somebody to advertise that house for you, find the renter, pay them a reasonable commission in order to find that renter, and then you just manage it from wherever you're going to be living. And for the most part, all you're doing is taking their rent check and depositing it in your account. You can even do that on an automated basis. Now, if you have an older house or even a newer house, it might make sense to have like a home warranty on the house and the name of a good handyman, a HVAC contractor, a landscaper, so that when little things go wrong, you can just get the right person over there and get it handled. So, yeah,
and you've got a great list for that.
Yeah, I got a little list for that on my app in the App Store, and it's just I call it, I think it's the John Cunningham app, and I've got all the vendors that I use and know and have built relationships with. So my clients, anybody who wants to download it can get access to that list. So I don't think being a landlord of your house is really all that challenging, but you're going to have more concerns doing that than you would if you just sold the place, because once you sell it, you're released from the property entirely. So the other nice thing about selling a place is you don't have to worry about, or you're able to reap those profits, whatever they are, right then and there. When it comes to the HELOC, can you talk about how long it takes to get one? I mean, I know you don't provide the HELOCs, but you sometimes advise people to get them?
Yep.
How quickly are they able to get them?
Ironically enough, they take a little bit longer than mortgages. They run in the 30 to 45 day realm.
Okay.
The other nice part about the line of credit sometimes is, depending on the value of the house, they will run what's called an AVM, or an automated valuation model. And if that value is high enough to get the line of credit you want, then there's no appraisal either. They just use the value that their automated system pulls. So it's pretty streamlined, but for some reason, the documentation is a little bit more thorough, because that second mortgage holder is in a weaker spot than your first mortgage holder. So
Okay.
you find that they do a little bit more dotting I's and crossing T's.
Okay, so are there any issues with buying this home as a primary residence if they currently live in Colorado and they are going to keep their existing house?
That's the intriguing part of most scenarios, especially when you're talking about an out-of-state borrower. So,
Well, Tom, those are the only kind of questions I ask, intriguing ones.
so so their primary residence is going to remain to be their home in Colorado. They're going to buy the place here as a second home. Second home rates, primary mortgage rates are identical, so there's no impact there. It actually makes their process cleaner to leave that as their primary. That's where their bank statements, pay stubs, tax returns all go. It is also that line of credit. Most line of credit companies are only going to give you that line of credit on a primary residence. So if you are buying Arizona as a primary, and they know that then that is going to become a secondary or an investment property, they're not going to approve that line of credit. So you have to also be able to systematically walk through that transaction to make sure you don't, get one good and to blow up the other. So you have to be able to make all the pieces come together. But for them, they'll keep Colorado as their primary.
Hey, I think we had a great conversation about how to buy a house before selling an old house. And if you have any questions about how to get the best mortgage rate, you ought to watch this video here where Tom and I talk about that.